Well, the fixed income market is the oldest and the largest of capital markets, but at times it can be a little difficult to explain and at times a little misunderstood. So I think the best way to think about it is to be aware there are two ways to raise capital. You can raise equity by issuing shares, or you can raise debt by issuing bonds or fixed income securities. And if you follow that vein through, fixed income is really lending, because at the end of the day, a fixed income security is a loan. Not necessarily all fixed income assets are defensive, and assuming that when you're allocating to fixed income you're looking for defensive attributes, you can probably boil the investable universe down to around three fairly simple categories. You can invest in things like cash, be it a bank bill or a CMT. You can lend to governments, which sometimes is referred to as sovereign debt. Or the third option that you've got is you can lend to non-government borrowers, which is sometimes referred to as credit investing. But it's really important that if you're looking for defensive attributes when you invest in credit, you've got to by and large keep it short and keep it high quality. The greater the credit risk that you take in that part of your investments, the greater the likelihood that you're actually introducing risks that you're seeking to avoid. Well, I'd go as far as saying that a good fixed income and a good defensive portfolio shouldn't be seen as an alternative, but as a really important complement to the other sorts of assets that you might hold. I think the big benefit of fixed income, or the big benefit of a defensive investment, is ultimately visibility and predictability to returns. So in essence, what you're looking for in that part of your portfolio is a great deal of confidence on the capital security investment, great liquidity or access to funds, and ultimately a reasonable and reliable income stream. From a portfolio construction perspective, a good defensive portfolio needs to have a low level of correlation to the other assets that you might ultimately hold. There are generally sort of two main drivers of both the risks and the return in fixed income markets, and in essence most securities, and for that matter most funds, can be mapped with a general understanding of those two investment concepts. The first is what's referred to as duration risk, and that's sometimes called interest rate risk. And really what that's talking to is the price sensitivity of a security or a fund to changes in interest rates. It's a really important concept for an investor to appreciate, because you can get fixed income securities that are issued at fixed rate bonds, or fixed income securities issued at floating rate bonds. And in essence, fixed rate securities move inversely with changes in price, i.e. when interest rates go up, they go down, where short duration or floating rate securities tend to have very low levels of interest rate risk and in essence reset to the underlying cash rates in very short intervals. The second risk is what you would call credit risk. And credit risk is really the premium that you get as an investor for lending to a non-government borrower, the risk of not getting paid back. And what you tend to find is you take on greater credit risk in the form of lower quality borrowers, greater subordination, or ultimately longer tenor to those loans, then you tend to get paid greater amounts of credit risk. Well, I think the beauty of debt lies in the asset class itself. There are some unique characteristics to fixed income that doesn't exist in other marketplaces. First and foremost, bonds mature, and that gives investors predictability in terms of a known point of return of their capital and also a known return on their capital. Secondly, bonds by their nature tend to be ranked higher up a company's capital structure. This is very important because in essence what it means is coupons are paid to bondholders before dividends are declared to shareholders. Another way of thinking about that is that bondholders get paid first and lose last. As a result, the returns in fixed income should understandably be lower, but they should be much more predictable, which is ultimately very, very important to many investors. I think what this means for investors is that debt or fixed income offers predictability. We don't necessarily know whether today's a good day to buy Telstra, what the price of Wesfarmers might be in 2 or 3 years, but what we do know as debt investors is those businesses will exist in 2 to 3 years. So making a loan to businesses like Telstra or Wesfarmers is a great way of giving the total portfolio the capacity to take equity risk in complement to the debt exposures you might hold in those type of businesses.